In Chapter 8, we are going to record closing entries and prepare a post-closing trial balance for a service business. This is the last step in our accounting cycle for a sole proprietorship. There is a need for permanent accounts and temporary accounts. We're going to talk about which ones are permanent and which ones are temporary. Delgado Web Services prepares a worksheet at the end of the fiscal period. They use it to journalize adjusting entries and to prepare the financial statements, and we've done that already. And they also use that worksheet. To complete other activities at the end of the fiscal period. And so this is what we're going to do is the end of period work, this chapter. Accounts used to accumulate information from one fiscal period to the other is called your permanent accounts. Okay, permanent accounts are also referred to as real accounts. Permanent accounts include assets, liabilities, and owner's equity, or your owner's capital account. And the ending account balance of permanent accounts for one fiscal period are the beginning account balances for the next fiscal period. So again, these permanent accounts here will always have balances in them. Okay? Some of them may have a zero balance, but they still have a balance because your liabilities, you may pay off your entire liability and therefore it would have a zero balance. But these accounts, assets, liabilities, and your owner's capital account are your permanent accounts, and they will have balances in them when you go on to the next fiscal period. Accounts used to accumulate information until it's transferred to the owner's capital account are called temporary accounts. Temporary accounts are also called nominal accounts. And your temporary accounts include your revenue, your expenses, your drawing account, plus a new one that we're going to go over this chapter is your income summary account. And so again, these are called temporary accounts because they are going to contain money in them. You're going to accumulate money in them, such as your miscellaneous expense, your sales account, and then eventually you're going to empty those accounts and put them into your owner's capital account. Okay, so they're just going to contain the money for the account or for the fiscal period, and then you dump them into your capital account. Temporary accounts show changes in owner's capital for a fiscal period. Balances of temporary accounts are transferred to your capital account, and that's what I was explaining before. So we're going to accumulate all of this money into our sales. At the end of the fiscal period, we're going to take the money out of our sales account and put it into our capital account. So temporary accounts begin each new fiscal period with a zero balance because we take the money out and we put it into our capital account. And again, just a reminder of those accounts is your revenue, your expense, and your drawing accounts. Journal entries used to prepare temporary accounts for a new fiscal period are called closing entries. Okay, so that's what we're going to do this chapter. Last chapter and the chapter before, we talked about adjusting entries to bring those accounts up to date. Our next ones are closing entries, and we're going to close out accounts and put it into our capital account and prepare them for the next fiscal period. The temporary account balances must be reduced to zero at the end of each fiscal period. So again, we're talking about the temporary accounts, which are your revenue, your expenses, and your drawing account, and eventually our income summary account once you learn that one. This procedure, by closing them out, this procedure prepares the temporary accounts for recording information about the next fiscal period. Temporary accounts must start each new fiscal period with a zero balance. To close temporary accounts, an amount equal to its balance is recorded in the account on the opposite side of the balance. So to close it out to create a zero balance, we're going to record an amount equal to its balance on the opposite side. For example, if an account has a credit balance of $3,000, a debit of $3,000 is recorded to close the account out. Whenever a temporary account is closed, the closing entry must have an equal debit and credit. If an account is debited for $3,000 to close the account, some other account must be credited for the same amount. Remember, our debits must always equal our credits in our journal entries. Another temporary account titled Income Summary is used to summarize the closing entries for the revenue and expense account. So again, we're going to use a new account called Income Summary, and you've seen it on your worksheet. It's popped up, but we're going to use this for a short period of time at the end of the fiscal period to close out our revenue and our expense accounts. The Income Summary account. The Income Summary account does not have a normal balance. Okay, it's a lot like our cash short and over. It doesn't have the normal balance. It is very unique. The balance of this account is determined by the amount posted to the account at the end of the fiscal period. If you look at this top part here, when revenue is greater than total expenses resulting in a net income, the Income Summary account has a credit balance. So you'd have your total expenses, your total revenue. When your revenue is greater than your expenses, it would have a credit balance of a net income. When your total expenses is greater than your revenue, resulting in a net loss, the Income Summary account would have a debit balance. So if your expenses are greater than your revenue, you would have a debit balance. So that's how your Income Summary works. Again, it just is used to summarize your revenue and expenses. Closing entries. An entry to close an income statement account with a credit balance. So there is 4 different types of closing entries. So number 1 is an entry to close our income statement with credit balances. 2 is an entry to close our income statement accounts with debit balances. So that would be our expenses. 3, an entry to close to record our income or loss and close out our income summary. And then 4 is an entry to close our drawing account. So basically, you are closing your revenue account. Then you are closing your expense account or accounts. Then you are transferring your net income or net loss and closing out income summary. And then you will close out your drawing account. So those are your 4 closing entries. The first one, we'll take a look at them here and then we'll do them together. But your first is a closing entry for an income statement account with credit balance. Okay, so you're going to look at your income statement on your worksheet. The only one with a credit balance is sales. So in order to close out that, if you look up here, you have your sales. It has a normal balance, credit balance. To close it out, we would have to debit it. Okay, and this would create a 0 balance. This number here, all you're doing is you're taking the balance here and you would be transferring it into your income summary. Okay, so the entry that goes in your journal would be a debit to sales and a credit to income summary. And that is what you have right down there. The second one is a closing entry for income statement balances with debit balances. So here are all your income statement debit balances. Okay, so in order to do that, all of these would have to create 0 balances here. We would have to credit them. Okay, so we would go down here. You can see that we're going to credit all of our expenses. The total amount gets transferred into our income summary account. So basically, we are cleaning out all of our income or our expense accounts, creating zero balances, because remember, those are temporary accounts, and we're putting all of that money into our income summary. So that's the representation of all of our expenses. The third closing entry is to record net income or net loss and close the income summary account. So really, our net income or net loss should be in our income summary account, because right now in our income summary account we have put two amounts. We have put our sales and we have put our expenses. And how did we figure out our net income? We took expenses minus or sales minus expenses. Okay, so we're taking this amount and we're going to put it in our capital account. Since it is a net income, it's going to increase capital. So to increase capital, you have to credit your capital account. Okay, and you can see this goes down here. The account that we are going to debit is our income summary. So we're going to take it out of our income summary and put it into our capital account. And the amount that is in our income summary right now is our net income. The fourth closing entry is for our drawing account. Okay, if you look up here, our drawing account has a normal debit balance. To create a zero balance, we would have to credit our drawing account. Drawing decreases capital. To decrease capital, you have to debit it. So you will debit your capital account, credit your drawing account. And those are your four closing entries. When you are done with your closing entries, you are going to prepare a post-closing trial balance. So you will journalize all of those entries and then you would post them. Okay, and you know how to post, so I'm not going to go through with that.